It says that as of October, Moody's Analytics believes that at the end of 2025, the federal funds rate will be about 4%, indicating 2 to 3 more 25 basis points cuts in 2025. And the Fed forecasts the 10-year rate to be around 4% in late 2025. So to be determined. I mean, if that's the case, then I think interest rates are somewhere between 5.5, 6.5, depending on the spread. But yeah, 30-year mortgage rates are still hovering around 7 with where we're kind of at today.
Welcome to the Peak Profits Podcast, your guide to maximizing returns in passive real estate investing. Hosted by Bryan Morris and Chris Ward of 7 Peak Capital, we dive into conversations with industry experts, sharing insights, strategies, and stories to elevate your investment portfolio. Whether you're a seasoned investor or just starting out, this podcast is designed to give you the edge for financial freedom. Get ready to unlock new opportunities, discover the secrets of successful investing, and take your passive real estate investments to the next level. Now, let's go reach those peak profits together.
Welcome back to Peak Profits. Today, Bryan and I are going to talk through 2025 multifamily outlook. So we're going to make probably a few bold predictions here. We're going to share what we are going to see and what we expect to see in the multifamily market. Bryan, first of all, how are you? Happy New Year.
Thank you. I am good. Happy New Year. I'm excited to go give a crack at this outlook. I know we have some reports that kind of we've been reading up on, and I think it's just good to hop on here and chat and kind of see what the 2025 outlook looks like, what we saw in 2024, and just give our perspective on it and see if we're right, look back at it in a year and kind of see what transpired. Obviously, there's a lot that could be unforeseen or certain circumstances that could happen. But I think there's a lot of good reports. Specifically, there's one that I was reading up about Freddie Mac, a big agency that kind of released what their outlook was. So probably take some reports and some things from there. But yeah, I'm excited to hop on and just have a conversation today.
Yeah, we'll probably call out a few areas on that Freddie Mac report, kind of where we're seeing some of those graphs, where those ultimately come from as well. So anyone listening, we're probably not going to share our screens, but you can download the graph and kind of reference back to what we might say in there, the key areas, and ultimately tying that back to what we're planning on investing in and some of the key things that we're ultimately looking for this year as well.
Yeah, I think we can add this to the show notes and then elaborate on kind of what we're seeing within this and go from there. But yeah, I'm excited to kind of where 2025 is heading for multifamily. 2024 is kind of a weird year. Like we thought we would have a little bit of a bounce back, but there was like low transaction volume. Obviously, interest rates were very volatile, right? Like we had the 10-year treasury went very low in September, like below 4, and we thought we were hitting a point where it was going to stay low, and it bounced back up to, I think right now it's at 4.7, 4.6. So I've seen a couple things where they're kind of baking in the new administration with some of the tariff stuff that could be inflationary, and also baking in 2 rate cuts, potentially 3 for next year. So it's at 4.75 going into 2025, and you have maybe 3 rate cuts at 25 basis points. You're sitting at about 4 at the end of the year, which kind of what this report is saying. So, I mean, I wish I had a crystal ball to know exactly where rates were going, but
do you think we'll get 3 rate cuts? Is that, if we were to put an actual prediction on it, I'm going to ask you for one. I'll give one. I personally don't think we'll see 3. I think it will actually be a lot less than that.
Yeah, I think
we'll probably end up, and again, you could argue, could we have 2 rate cuts or 3 rate cuts and a rate increase throughout the year, right? But I don't see it going down to 4, would be my 2 cents on the whole.
So part of this report, they cut the 50 basis points in September, and then they cut another 25 basis points in November. But essentially where we're at right now, we are, again, sitting above 4.5. And it says that as of October, Moody's Analytics believes that at the end of 2025, the federal funds rate will be about 4%, indicating 2 to 3 more 25 basis points cuts in 2025. and the Fed forecasts the 10-year rate to be around 4% in late 2025. So to be determined. I mean, if that's the case, then I think interest rates are somewhere between 5.5, 6.5, depending on kind of the spread. But yeah, 30-year mortgage rates are still hovering around 7 with where we're kind of at today. So, I mean, I think they said at one point this year, they dropped below the 30-year residential interest rate for housing dropped below 6 at one point at 5.9. And they saw a big increase in residential volume, just dipping below that 6% range. But we're a little bit above that now again, and transactions have been slow. But again, I think we see a little bit of a softer and a little bit of a decline in rates next year, hopefully.
Yeah.
But yeah, to be determined, I guess we'll see.
Yeah. Look, I do think they'll go down. I can't see it really being 3 times. I think 2 would probably be where I would guess, but 3 I just feel like will be too drastic immediately. I ultimately think they'll finish around 4.25, so I'm going to go in like kind of in the middle. Safe bet straight out of the gate. But
so is that your stamp for December of 2025? You think 4.25 around the 10-year treasury?
I would say yes. That's where I would go. Where would you go? Are you going to go with 4? Are you going to follow the analytics, or are you going to bend off and go your own way slightly?
Real quick, while we're on it, let me look at the 10-year treasury yield today. So I can go. All right, so it's 4.646. So down a little bit even from a few weeks ago. And I'm going to say 4.1. 10-year treasury in December, because it has come down a little bit. It was 4.8, which was the highest it got on January 13th. So yeah, we'll see. To compare that, on September 16th, it was 3.6. So like that's a drastic change already, like in the matter of 3 months. So there's still a lot of volatility and what's going on. Again, that's right before the election.
That's a lot of the uncertainty, right? Like, is how quickly that is changing is like,
because
it's extremely volatile.
With these multifamily projects, you're going to get something under contract, right? And it's going to take 3 to 4 months to close. And you don't usually lock the rate until closer to close. So, you can't necessarily predict what the next 3 to 4 months will do as you're going through due diligence, raising funds, getting everything aligned so you can get to the closing table. And, 7 to 10 days before closing or 7 to 14 days before closing, when you go to your lender and lock the rate, where is it at that point, right? So, yeah, but with it being that low in September, and then we had the election year, obviously, not knowing who would be in office at that point, and then, I think some of this is baked into, one, the new administration, what he's talking about with tariffs, and then kind of baking in some of those forecasted at least 2 rate cuts. So at this point, with it sitting at a little over 4.5, if you have the 2 rate cuts, then you are sitting about 4. So we'll see what happens, but it's good to always kind of check this daily or weekly to see kind of.
Yeah, it's definitely a good indicator as well of the direction everything's going in. It's obviously very hard to predict without a wonderful crystal ball, and I'm sure if we all had a crystal ball sat here predicting it, we would drive our investments in specific ways as well. But there's also a really interesting point that I see in this report. I'm just going to jump forwards through a few pages so we can jump back and forth, but this one specifically is on page 7 around kind of the multifamily demand and supply. And it talks about how even though there is higher supply than there really ever has been, and in Q3 of 2024, the deliveries were the highest that they have been than any year going back to 1980. Right, so deliveries of multifamilies were high, but in the same time in Q3 of 2024, there were also the most multifamily starts were impacted through the first 3 quarters of 2024, and that all really ties back to various different financing options. So when we talk about the treasury being so volatile throughout the year, those financing options, and as you just explained there, like when you're going to the bank to try and lock those final rates in, if suddenly your rates are 0.5%, 1% higher, maybe the numbers no longer make sense, right? And then going back to the sellers and trying to renegotiate what the prices will ultimately be, and what you believe the fair value of that and what you can ultimately even get back from the bank are drastically different.
Yeah,
Again, this does talk a lot about kind of new build construction and kind of multifamily permits, multifamily starts, right? So it's not necessarily just sellers, it's also the cost of the land if you're doing brand new construction, right? But all of that does impact ultimately the overall supply and demand of the multifamily market. So
well, what
again,
you're
I'll be
seeing with
interested.
with what you're seeing with the delivery, like to your point, last year, and the supply being so high is because rates were 2.5, 3. Money was so cheap in 2020, 2021, late 2020, 2021, 2022, with after the COVID, right? It was so cheap. Money was essentially damn near free. And
Yeah.
so there was so much construction, so much starts and supply. And so now you're seeing the completions of a lot of that where they're coming online. And to your point now, last year, though, when you look at permitting and starts, they were down 20 to 28% on. So permits were down 20% and starts were down 28%. And you've seen that where it says the lowest level in a decade because, again, what did rates do after 2022, right? They shot up. So now people aren't borrowing that money and aren't starting or requesting permits and getting things and projects going. And so now what we're going to see over the next few years is supply is going to drastically fall off the cliff. There's not going to be as much new development. And so now I think they're starting to start again. You're starting to see that pick up a little bit more. But yeah, it was quite a ride when they were starting the development in 21, 22. Now they're delivering that product. But here we are in 24. They weren't starting much of anything. So the next few years will be very light. But to your point, with the amount of supply coming online, the absorption rate was actually very high. It said the resilience of the multifamily market in the face of the highest level of supply since the 1980s. Demand has been exceptional. Rent growth over the past year has been modest, while vacancy rates have still held relatively constant. Right. So what they're saying here is for 2025, they predict positive rent growth, but below long-term averages still. So, right, you have a lot of supply, and they're actually saying surprisingly how much absorption of that supply is still getting picked up, right? Because of, I think that correlates back to, you see the residential housing market. It's becoming unaffordable for people to potentially buy. So there's still a lot of renters out there at this point, and there's not as much going on in residential housing with where the rates are. So I mentioned earlier, like the rates dipped slightly below 6 at one point, and then you had a little bit of an uptick in that residential space, but we're back up towards 7%. And so people aren't as active in the single family housing. And so you're seeing a lot of renters though.
And I think it's a conversation we had the other day as well, right? Is do people even want to be buying right now, right? Like is that what people are looking for? Or do they want the flexibility and the freedom to be able to rent short term, travel where they want to travel? With remote working, you no longer are required to be in the office. You can probably test out new states, new areas that maybe you haven't lived before. So all of that does play into that as well. And again, I think we will continue to see that. What I do think that really kind of highlights when we relate this back to deal flow and opportunities is that forced appreciation is going to be a lot harder for multifamily operators because you're not going to be able to push rents up as quickly. You're not going to be able to demand as high of a premium potentially based on the renovations you're doing. So is that the strategy moving forwards for the next couple of years, to be trying to renovate the insides of units, right? Or are you looking at more of the operational side? And I think it was 2023 and 2024 where everyone was talking about like, these are the years where operations are really going to be the ones that are driving the value add to your properties. And I think we'll see that continue over the next few years with things like tax abatements, offering additional things such as storage or parking, dog parks, laundry, right? Those are the areas where we'll be able to increase the NOI in the multifamily properties. I don't think fully renovating units will be as popular. Obviously, it's still going to make sense, right? If you have an older vintage and the units have never been they're still the originals. Of course, there is still value in doing that and being able to increase the rents that way. But I think we're going to see more and more business plans come out with additional, more operational focused ways to drive up the NOI instead of what I would say the kind of in 2022, it felt like everyone was going in and being like, okay, here's what we're going to do. We're going to buy, we're going to renovate almost every unit, and then we're going to charge $300, $400 more.
Rent growth even then was like double digits. And so like you could just ride the wave even if you didn't operate it properly.
So yeah, I think the operational years are still going to be here and be extremely important. So those, I think, are key things that really all tie together on that side of things as well.
Yeah, I think
actually there is, if you go to Exhibit 5, it does have a cool graph that looks forward all the way into Q3 of 2026 that talks about the supply wave, and it does have it really topping out kind of now, Q4, Q1 of 2025. And then we see a pretty drastic drop off, right, from 7% all the way down to below 3%. So that's pretty telling for what we've just been saying as well.
Right. Yeah, it's definitely interesting kind of where we're at. I think, to your point there with some other strategies, right? We obviously have a shortage in the US with affordable housing and the costs of everything, including rent, including groceries. And I swear my Whole Foods bill is far too much every week. And I don't even buy meat. We get the butcher box meat. But yeah, so it's definitely causing a strain on a lot of people. So like the incentives to provide affordable housing, I think many times you're seeing, you alluded to the tax abatement strategies, whereas, this is happening a lot of times. And in Houston and Texas overall, like we've had a couple partners that we've worked with that have done this strategy time and time again to not only provide affordable housing to workforce, blue collar tenants, to provide still a great unit without feeling the excess strain on premium rents. So you're still getting a great unit at a great price that's in line with the market, and by incentivizing with the tax abatement, right, it's making the numbers work for an investor to come in and also operate that. So it kind of helps out both parties, right? It helps out the tenant base who's looking for a nice place to live, but it also helping out investors who are looking to purchase these assets that are a little bit older or could use some work, or even just assets in good areas that maybe be overlooked and don't have enough meat on the bone to maybe make sense. So what is the city or the state trying to do? They're doing these tax abatement strategies by cutting the largest expense on the operating expenses, right? So if you're cutting that by 50, 75, 80%, it's going to make a drastic change in the net operating income. So it does work out for all parties there. And it's a strategy that works well and has been working well. And there's also less risk in that, in my opinion, without having to go in and renovate units and disrupt occupancy and doing things like the property can still maintain operationally without any disruption, and you're just getting a drastic boost in the NOI by cutting expenses rather than increasing income right away. Whereas to your point, if you're renovating units and trying to push rents as aggressively or up to market, you're actively trying to increase that income versus cutting expenses. So you're still increasing the bottom line of the NOI. You're just doing it in a different way.
Absolutely. What about vacancy or occupancy rates, right? Like with a lot of new supply coming in, typically that does kind of push some challenges in terms of occupancy and vacancy rates. And we have seen that kind of be a little bit of a challenge, if you will, right, in various different markets. I think as you mentioned that specifically Austin had like huge supply come through, so their occupancy rates went down, so vacancy obviously went up. Whereas when you look at the kind of tertiary or secondary markets, they don't have as much supply. So when you are seeing these high numbers of supply, right, those are in specific areas, major metros. That's where you're seeing a lot more of that stuff. So the secondary and tertiary markets, I don't think have been as impacted with that, which again, I think it goes along with some of the stuff that we've definitely looked at is finding those pockets and those secondary or tertiary markets that are outside the major metros, right? So if you're in North Carolina, you've obviously got Greensboro. If you're looking down in Texas, right, we just invested in Waco. So again, there's various different tertiary markets that I don't think are going to be as impacted by that new supply either. And in fact, the one that we just invested in was expecting to have no new supply, right? So really the biggest risk is just other operators and other assets being very, very aggressive with their leasing strategies to try and drive down either rents or offering, like we saw in COVID, 3 months, right? Just to build up their occupancy rates. But how do you feel about that stuff? Do you think that's going to cause issues in 2025? What's your feeling there?
Yeah, I mean, to your point on some of those major markets, like you saw, as I mentioned, like how cheap money was in 21, so much supply went up in Austin, and like they're just following the migration patterns, right? Like so many people are moving out of like California or moving out of New York or moving out of these different states and moving either to Texas, which is like one of the biggest ones, the Carolinas, Florida, and you're seeing that's why those rent increases were double digits for those couple years. And now all that supply that they were building, and Austin specifically, it's oversupply. So they are offering concessions. Like Austin rents have actually gone down about 7%. And that'll get absorbed and those rents will stay like stagnant and then generally gradually start to rise again, I'd imagine, in the next year or two. But and it's still going to be a market where a lot of people are migrating to. But to your point on our Waco investment, Waco's a submarket that essentially is right on the I-5 corridor in between Dallas MSA, which is north, and Austin MSA, which is south. And Waco finds itself right in the middle of that. And we liked the investment opportunity that was brought to us in that market because of the multiple reasons you mentioned. There was limited supply coming on, right? So if you look at 2025 projected, there's just 463 units being delivered in Waco. And then in 2026, guess how many units are being delivered to projected in Waco?
255.
So like, yeah. So you're kind of seeing kind of that play out now where we're not really having to worry about new supply in the Waco market. And we were able to leverage with Post Real Estate Group that tax abatement strategy at the Azure Apartments that we just finished our raise on. So we're excited about this investment. It's going to boost the NOI on the day of close by over $200,000. So that's obviously a big play. And then with limited supply coming on, the occupancy within this apartment complex already is 94% and has hovered in the mid 90s for the last decade. So we don't have to disrupt any of that occupancy. So a lot of reasons why we are excited about that property, but being in that Waco market, we're not seeing that crazy supply that, Austin is just south of it in the MSA.
Yeah. What's your overall expectation? Like, what do you think of the 2025 market for multifamily specifically, right? Like, how do you think it's going to perform? Do you think we've seen the bottom, or do you think we're still going to be there or thereabouts as we navigate through 2025, and as we get into 26, 27, that's where we're going to start seeing the increase again? Like, what's your opinions there? Because I was listening to a podcast with Justin Wheeler, the CEO of Arcadia, on it, and he shared that he thought that because everything was slow, he does still think it's going to continue to be a little bit slower through 2025, and that over time, what they're trying to focus on now is really continuing to maintain their staff and their teams, so that as and when they start to see the rise and the pickup again, they're going to continue to be able to act they have put more offers in on properties, he said, over the past 2 or 3 years, but they just haven't been successful in ultimately closing all of those because of the difference between the valuation that sellers still have and ultimately what the banks will ultimately lend. So at some point that has to correct itself, right? Like that will ultimately correct itself. But do you think that happens in 2025, or do you think that starts to happen as we go into 26, or maybe even later?
Yeah, I think the transaction volume will pick up in 2025 compared to 2024, right? So there's going to be some positive movement. I think there's a lot of cash on the sidelines waiting for the market to kind of pick back up. So like in 2021, 2022, when rates were 2.5, 3.5%, rents were going double digits, these properties were trading at all-time high valuations. Like we're seeing 20 to 25% discounts off those prices. And some of the cap rates change between that, right? But I think we're going to see even better deals probably the second half of 2025, because you've probably heard this, like a lot of these operators are kicking the can down the road with some of their properties that they got in 2021 and 2022 at these low rates. Generally for those who like residential versus commercial lending is completely different. So in commercial lending, a lot of these operators might have floating rate debt or 3 to 5 year loans where they're going to have to either refinance their bridge debt, or they're going to have to refinance their 5 year loan that's coming up to a balloon payment. And general math, if you're going to get a rate at 3% and then try to refinance at 6.5, 7%, that's going to drastically change. So I think a lot of lenders, from what we were hearing, were helping out operators by like extending, right? The extended
Very
term.
lenient, if you will,
Right.
from the banks. And how long does that last, right? Because at some point the banks are going to go, enough's enough. Like it's time for you to either pay me that balloon payment or refinance into a.
And that's where a lot of those forced sales are going to be, where people might have to sell at a valuation, obviously, that's lower than they wanted to, and sell at a discount. Hopefully don't lose money on the deal. But this is where you can scoop up properties at a greater discount. And I think if you get into projects this year, heading into next year, a lot of these business plans are 4, 5, 7 years. So you're riding that wave back up, right? The supply is going to drop off. We expect to see rent growth again. You combine that with what we're seeing in the residential market, like the housing market purchases really necessarily haven't picked up. And will they pick up later this year into 26? Maybe. But you can argue that that also could help the multifamily space. So, yeah, well, I think that is going to be an interesting thing to look at. I think there's going to be a lot of good deals to be had in 2020, like late 2025, heading into 2026. And again, the business plans projecting into the early 2030s, like 2030, 2031 projections and full cycle deals. I think it's a good time to get into deals for sure.
Yeah, and I think it's also important just to look at the underwriting, right? To make sure that things aren't being underwritten with 5% rent growth year over year, right? Because those just aren't realistic. I think 5 is probably high. I think most people typically would come in at a 3%, but even that at this point, like how realistic is 3%, right? Is that as conservative as you may want it to be? Well, that all depends, right? Like it depends on the market, depends on the locations, because there are still some markets that are performing well above 3% in terms of rent growth. Those are really important things to be looking at, as well as obviously the interest rates. But to your point, that's so hard because that can change all the way up until the day before. Well, it can change all the way up until the day you're trying to secure the loan, right? So,
yeah. And I think that's a good point. Like we're talking in generality here, like from a nationwide, like there's so many markets still too, like that are doing well, that like don't have the type of supply that like an Austin does, like a Midwest, right, is still seeing, good deals and cash flow opportunities. There are some tertiary markets and some submarkets that are still doing very well and that are hot. So I think it's all relative when we're kind of talking in general numbers here for the overall 2024 year and country. But yeah, that's why you want to try to dig into specific markets that you like, specific markets that you have either partners in or people that really understand that market. They specialize in that market. They know the trends and kind of what's happening. And then to your point, like look at the underwriting. make sure you understand kind of what those projections look like. If I'm getting brought a deal right now in Austin that is projecting a 5% rent increase, I don't know about that. We're going backwards here, buddy.
Yeah.
So yeah,
I actually have got the rent growth from Q3 here. It's on the report. The lowest across the country was in the Sun Belt, which was minus 2.6% rent growth. The highest was in Central and Plains, which was rent growth of 2.8%. And then you've got the Northeast and Mid-Atlantic, 2.3, Mountain West, minus 1.4, and then the Western side at 0.2, right? So even there, you can see like how that fluctuates like massively across various different parts of the country. And like you said, it's all about understanding the specific markets that you're looking at. And if you don't ask the questions, right, like those are the questions to be asking. Well, why do you think that you can achieve 3% rent growth year over year when the rest of the market is projecting a minus or a static or even just a 1%, 2% rent growth, right? Like those are the questions to be asking and understanding. And then you can make your ultimate decision on whether you agree with that business plan, whether you don't agree with that business plan, move forwards ultimately from there. But I do think a lot of this stuff, it's really interesting and quite telling, and it's almost fascinating to see how people are predicting and projecting various different avenues, and ultimately no one has a crystal ball, right? Like there's a lot of things that can impact all of it. Hopefully we do see rates come back down, and hopefully we do see a lot of occupancy go up. And I think the occupancy ultimately, like you said, with supply really coming down now, naturally that would say that occupancy is going to start going up, right? So that's really what I'm looking forward to, is seeing a lot of that transpire in 2025.
Yeah, I think again, we're not magicians or psychics or whatever the word is, but we can give our best guess. And I think reading through reports and understanding kind of what people are projecting, or some of these biggest firms in the industry. And so, in wrapping up kind of this Freddie Mac report, they're saying that given a stable economy, which is essentially no crazy unforeseen circumstance like COVID or, something that we could have never guessed to see, but we expect the multifamily market to perform modestly well in 2025, with both rent growth and occupancy below historic average, but demand has been strong in 2024, and this is a trend that we expect to continue in 2025. And with the amount of supply, they still see top demand for this multifamily sector. And I think, when you're looking at performance across the nation, many of the large, Sunbelt and Mountain West markets are seeing very high levels of supply, causing a slight lag in performance, which we had touched on slightly. And then conversely, markets with lower supply, like we mentioned, Waco, or some of these sub markets, are expected to see stronger performance in 2025, which is kind of what we like to see and kind of where we're trying to focus on. Transaction volume picked up in 2024. I think it's going to continue to pick up slightly in 2025. Then, 10-year treasury rates, again, have been very volatile. So keep an eye on that, and hopefully we can get to a point where it's a little bit more predictable. But again, I think they're kind of baking in those 2 to 3 cuts. We'll see how many they decide to do, and then expect volume increase in 2025 as interest rates continue to stabilize. To be determined. We'll see what happens, but I think we're at a point now, after the craziness of obviously what COVID was, and then the super low interest rates in 21, 22, and then crazy sales and starts. We're at a point where it's a little bit more stabilized going into 2025, and I think it's a nice outlook heading into the next few years in multifamily, and a lot of positives. So getting into deals and obviously doing the correct due diligence and understanding what deals you're getting into, what's the business plan, how are they, again, to your point, looking to increase the NOI? Is that rent growth? Is that other tax abatement strategies and whatnot? But yeah, it's exciting. We'll see what happens. We'll have to look back on this podcast early 2026 and be like, wow, we actually were pretty good, or we just absolutely swung and missed. But hopefully not swing and miss.
I agree. And ultimately, would love to hear your thoughts on this too, right? So if you're watching this on YouTube, put some comments down on what your thoughts are for the 2025 outlook, and we'll see ultimately where where we all get to. We're going to do more of these moving forwards. I think we still want to continue to get guests on. We've got a number of guests already locked in and lined up, and we're excited to share those with you as well. But you can expect to see more of us kind of just talking about what we're seeing in the space in 2025 and moving forwards as well. So, Bryan, appreciate your time. And like you said, we'll see exactly what happens this time next year and whether we were right or wrong.
Yeah, thanks, Chris. And we'll be back on soon and excited for the next guest we have.
Thank you for tuning in to the Peak Profits Podcast. We hope today's episode was not only inspiring, but packed with actionable insights for your passive real estate investments. Subscribe so you never miss an episode. And if you enjoyed the show, please leave us a review. Your feedback fuels our passion to bring you even more valuable content. Stay connected with us on social media and visit 7peakcapital.com for exclusive resources and updates. Until next time, keep striving towards your financial goals and let's reach new peaks together.